to the floor, so to speak, for any other questions. I'll let Andy and Susana start off. You should all be able to see their presentation. If you have any technical difficulties or the Skype for some reason goes out, just re-click that Skype link to join. And then again, you can always use that chat window. I'll be moderating that as well. Thank you so much, and I'll pass it off to Andy and Susana.
Thank you, Molly. And this is obviously Andy speaking at this point. So good afternoon, everybody. I'm delighted to be here virtually this afternoon to cover a topic that's likely on the minds of many now, given the high degree of uncertainty due to the COVID crisis. To state the obvious, much has changed in dramatic fashion over the past couple months. Frankly, 2020 was not supposed to play out like this. It was supposed to be a relatively good year for many parts of the world. So our hope today is that we'll be able to share and offer some valuable perspectives on where this could head based on our past experiences, sharing some thoughts on how to think about emerging risks in a structured way, and then finally equip you with the knowledge you need about the tools available to manage through these risks to protect yourself, not only now, but of equal importance to position yourself to safely capitalize on healthy forecasted growth rates around the world, at least in the medium term. So by way of general comment, and I think many would agree, the markets that often tend to be perceived as risky are also those that often have the most potential reward. And the challenge is really successfully navigating that dichotomy. It's the challenge and, of course, the opportunity. If we move now to the second slide, you'll see brief bios for me and Susana Chamlee, the other presenter from the bank today. I won't bore you with the details of our bios, but I do want to point out an aspect of what we do at the bank that will shape our approach today. We have both formal risk and line of business management responsibilities. Part of our job is providing analytic-based recommendations upstream regarding where the bank should put its own capital at risk across the world, while another part of our job is developing and executing business strategies underneath of this risk guidance that we're providing. We're practitioners on this topic, not simply academics. So in effect, in what we do day to day, we're threading the risk return needle, if you will. And it's really this threading ability that we're hopeful that we'll be able to help you enhance during our presentation this afternoon. If we can move to slide 3. So here we're primarily providing an agenda and an overview. Keeping it simple, we're going to start by providing a launching point by sharing our view of the world and what's next against the backdrop of COVID, among some other dynamics as well. Then we'll cover the main forms of risks when operating globally, offering some useful concepts and tools that we use at the bank to assess these risks, and then wrap up by covering some common risk mitigation tools and strategies. All right, let's go to slide 4, and we'll get to it here. So starting out with our brief view of the world, for the most part, we're going to focus on life after COVID here. I don't see huge value in spending time to prove that it's going to be somewhat doom and gloom here in 2020. I think that's obvious to even the most casual observer at this point. So I do want to point out that the views that I'm expressing today are influenced by about 25 years of experience in global markets. However, they are based on professional judgment, not object precedent. We've not seen an event quite like this one, at least not as severe as this one, and frankly, with its nature. So trying to look beyond its aftermath isn't easy. I tell you this because I encourage you to cast a wide net and get views from as many experts as you can. At the end of the day, if I'm being honest, none of us are going to nail this. It's probably going to be a mixture of the various predictions that we'll see survive once the dust settles. Okay, now provisos aside, here's my view on where this is headed. The table provided contains growth forecasts published by the IMF from a few weeks ago in early April. I like IMF data as I find it to be more objectively derived than some other sources. And when you look at this table collectively, the countries in geographic groupings represent more than 80% of global economic output. So when I look at these values, I'm not surprised to see the correction in 2020 versus 2019, since for all intent and purposes, many regions have engaged in extended lockdowns, many ceasing most economic activity. However, to be honest, I did have some sticker shock here with the depth of the forecast, seeing -6% for the US, -7% for Europe, China down to only 1% growth, and emerging markets collectively shrinking by 1%. All of this, of course, collectively pulling the world down by 3% for the year. Now, giving some context, that's about 3 times the depth of what we saw during the global financial crisis in 2008 to 2009, and would be the worst reading since the Great Depression. A key difference I see in COVID versus the financial crisis is that both advanced economies and emerging markets are contracting now. During the financial crisis, the emerging market continued to grow, which did provide some pocketed tailwinds. If there is a saving grace here in the near term, it's going to be the strength of the global banking system. A financial system meltdown on top of COVID would be tough, to be honest. But painting in very broad brushes, major banking markets across the globe are in substantially stronger footing, particularly from a capital and liquidity perspective, much more so than the last crisis on a global basis that we experienced. So perhaps this time, instead of the financials kind of weighing down the recovery, perhaps it can be a tailwind as we emerge here from COVID. Now, let's move beyond the tough forecast in the second half of 2020 and focus some on 2021. There are a lot of different forecasts out there for the shape of the post-COVID recovery. The consensus seems to be a check mark, which is my view as well. For those of you unfamiliar, a check mark is basically a slow but consistent build. This makes more sense to me than a quick bounce or even a prolonged lull. To some degree, the world is hitting reboot here. When I look at the 2021 forecasts, they're healthy and they're broad-based, with China surging over 9%, both the U.S. and Europe coming in around 4.5%, and emerging markets back up to 6.5%, with 6% for the globe. This is healthy. We haven't seen that level of growth in some time. The question in my mind, frankly, is will it happen? And that's where I get concerned. So virtually every forecast you see assumes an orderly emergence from COVID, basically no relapses with increases in cases, for example. I can see why that assumption is made as a forecasting convention, but let's be honest, there's really no precedent here to give us any reasonable degree of certainty. But let's accept that the premise that the world is going to get this right for this discussion. Does this mean that smooth sailing? Almost certainly no, in my opinion. I think the waters are going to be choppy in spite of good growth prospects. So what is weighing on my mind? I think if there's an item more than any other, it's the massive level of debt-funded stimulus that we're seeing across the world. The levels of debt are certainly necessary to save economies, even in the U.S. and Europe, but the level itself is relatively astounding. But once again, the lesser of the potential evils. We've never seen anything like this in terms of the leverage as a percentage of gross domestic product, particularly in advanced markets. My sense is that this isn't a short-term issue in advanced markets, save maybe Italy due to specific challenges, given the low level of interest rates that seem likely to prevail for some time. However, over time, I do worry about that eroding advanced market competitiveness. Now, emerging markets, on the other hand, are more concerning to me. Ironically, debt levels aren't as deep as what we see in advanced economies now. But what concerns me is the ability of these countries to obtain the necessary financing to propel themselves from the current crisis. The world is about to be flooded with sovereign debt securities from all over the world, frankly. And the question is there going to be enough powder for everybody? I don't know the answer to that question. Only time will tell on this. Now, are there particular countries that trouble me? Yes. I worry about countries with high levels of external or foreign currency debt. Turkey is one that comes to mind. And I also worry about the heavy oil producing countries outside of the wealthy Gulf countries. One that comes to mind is certainly Nigeria at this point, but there are others. I think this situation is where you're going to see the blow-ups if they occur. Now, I'll be watching these countries among several others closely over the next 12 months. I think we could go deep into a lot of countries here and probably spend our full session just on any particular country, but that's obviously not practical with the amount of time that we have allotted today. So having said that, we're certainly open to deeper conversation with any of the participants on any particular country that you have an interest in. We do cover around 35 different countries within the group at the bank, so don't be shy. Feel free to engage us in conversation if you like. Now, so what's likely to happen near term as we emerge from COVID? Well, the only real precedent we have is China, who is a few months ahead of us. What we're seeing there is a slow but consistent emergence with what seems to be no meaningful lapses in terms of cases, assuming, of course, we're getting the full story, and I'm kind of knocking on wood, hoping there, because you never really know. Now, interestingly, manufacturing in China quickly rebounded to expansion, whereas services remained in recession. I didn't expect this. So really the question becomes, what does this mean? It means that while people could return to normal life, they had chosen to do it quite slowly. Is this going to happen in the U.S.? My suspicion is that that's probably likely, which does again support that checkmark recovery view that I and many others have. In fact, it's actually quite a headwind in the U.S., given that 70% of our economy is indeed service-based. Now, let's try to forecast this way forward. So what's going to happen long term here? In my opinion, we're going to see a couple things. First, I think you'll see a better balance between nationalistic politics, and global cooperation. A major global event like this puts into perspective the need for the globe to work together efficiently. The second trend I think you'll see is a de-risking of global supply chains, given some of the stresses that we've seen, not just here, but also with the trade tensions that we've endured over the last year. How is this going to play out? I think you're going to see two trends here. It's my firm belief that companies, particularly large ones, won't confine themselves for their home markets. And obviously, if large companies don't do that, that will have downstream impacts to small and mid-sized companies as well. I think they won't confine themselves to home markets because growth opportunities are 100% additive, and quite frankly, they're compelling across the globe. What I think you'll see is this de-risk occur via the emergence of a build where you sell model, which of course that implies less export-import business, and also proliferation of regional supply chains. If you were to push me to pick the biggest country benefactors, if my theory is right, I'd go with Mexico and India. I think the geographical proximities to major countries, their scale and cost advantages, with the big caveat that they'll need to continue to make efficiency advances, I think this really positioned these countries well to capitalize on changing trends. This was already happening. We were observing this to a degree as a result of trade tensions between major economies, most notably the U.S. and China. While I suspect that many may view my thinking as against the grain thinking, I think as the dust settles, we're more likely to see more foreign direct investment in both emerging markets and, frankly, advanced markets as well as companies pursue to better regionalize and de-risk the supply chains. Now, if I'm right, that means that we'll need to understand the risks associated with it and those that we're likely to be confronted with and know how to deal with them. And this takes me on to slide 5. Okay, there we go. So our topic today is geopolitical risk. Simply put, this is loss associated with political changes or instability in a country. Based on my experience, I think companies have a tendency to underestimate this until indeed there is a crisis like we're seeing now. There seems to be an over-reliance on economic data, and that, of course, it is important, but that's not what brings you generally in the short run It's the hard to foresee sudden stop episodes that really sneak up on you and hit you. Now, in terms of geopolitical risk itself, it's easy to think of in four basic categories. The first one being transfer risk, or a foreign government imposing some form of currency control that keeps you from getting currency, normally US dollars, out of a particular country. The second is expropriation risk, a foreign government basically taking private property for public use. Then we have regulatory risks, so think things like country-specific sanction regimes and violations that could occur as a result. And then finally, legal risk, basically the predictability and fairness of a local legal system in settling disputes. We're going to cover tools to manage these risks later in the presentation, but I'll share just some high-level thoughts here. So first, emerging markets generally carry more geopolitical risk than advanced economies. I think this is likely intuitive for many of you. Second, a foreign customer's creditworthiness, while obviously very important, offers no protection from geopolitical events. I advise many companies on international matters, and it's more common than you would think for companies to look past other forms of risk because they have a solid customer on the other end. A quality customer, as I mentioned, very important, but it can be dangerous if it's over-relied on. And lastly, the importance of economic trends become more meaningful as the time horizon of the investment increases. There are, of course, many more nuances than this, but these are some basic tenets that are always helpful to have in mind, in my opinion. Okay, so let's take up the topic of how to assess this risk. Where do we go for good information? And that's going to take us over to slide 6. So do media headlines have the information that we need? Now, I'm going to stop short here of claiming fake news, but I encourage you not to chase headlines. Read them because at times you can get some early warnings, but realize you are generally reading something aimed at entertaining readers, not necessarily helping you assess and manage risk, at least professionally. A particular quote from a book written by Ruchir Sharma titled The Rise and Fall of Nations comes to mind on this topic. The quote is, the global media's love is a bad sign for any economy, and its indifference is a good one. I honestly think that's pretty good advice, and I'll give you an example. The media tends to have bad timing. Oftentimes the exact opposite of what they publish is what's really occurring. And the real-time example that I'll give you is with The Economist, the publication, of course, and Brazil. So anyone on the line that's familiar with Brazil knows that the last 5 years have been pretty rocky. So back in 2014, the Economist published an article with the Christ Redeemer statue over Rio. That's the Jesus statue. And the statue had its arms spread that was something along the lines of Brazil has arrived. Well, anybody with real knowledge of the market knew the wheels were starting to come off then. Now, roll that forward to the summer of 2016, they published the exact same statue, but this time with its hands covering its eyes to hold back tears. Well, again, for those that were tracking the market closely and visiting, it was quite clear that they were starting to pull out of their severe recession. Now, I'm not trying to pick on The Economist. I actually like it. I subscribe and I read it. I'm just making the point that you need to be very careful with daily headlines. So that really begs the question, if the headlines don't have the answers, where can we go? And to answer that question, I'm going to pass the mic to my colleague, Susana Chamlee. Susana, among other responsibilities, leads the country risk analytics group at the bank. She's going to share some useful resources with you that we use for our own account when we're managing risk, and also offer some insights assessing and monitoring this type of risk. Go ahead, Susana.
Thanks, Andy, and thank you for having us here today again. So yeah, as Andy mentioned, how should you and your companies gauge international risk? So I'll kind of walk through this topic from the viewpoint of a company looking or that does engage in internationally, and we'll go from there. Obviously, if you have any questions, save them towards the end or put them in the comments of the Skype. But from my perspective, the best place to start is by thinking through the type of activity your company is looking to or does engage in internationally. Whether this be signing a sales or supplier contract with an international customer on one end of the spectrum, or setting up shop or establishing an actual physical presence internationally on the opposite end of the spectrum. And then there's everything in between. The breadth and depth of the due diligence that you will want to do and the gauging of country risk and the 4 risks that Andy mentioned will be based on this, will be based on your company's objectives here. So once you and other leaders in your company are clear on the type of business conducted internationally, the next step is still internal looking, and that is to be sure that there's a consistent and bias-free mindset as you move forward with your process. Now, this is simple and yet challenging. However, it's an essential step if your company is to succeed growing internationally. Each country has their unique dynamics, culture, characteristics, and you may be feeling that perhaps you're expanding or starting a new contract in a country that seems very similar to your own. Even so, there can be large differences in legal systems, tax frameworks, economic drivers, or even privacy or soliciting laws. So first up, the breadth and depth of your international engagement. Second step, acknowledging yet challenging biases. And once those have been solidified, now is the time to start that external due diligence and engage a competent advisor. I'd suggest, much like many are doing today, engaging with your local Chamber of Commerce, engaging in their events. Members tend to be businesses or professionals that are conducting similar business, and chambers provide many events, much like this one, that go into depth on a particular topic. This is fertile ground to find a good advisor. So feel free, give yourself a pat on the back for being here today. So lastly, as noted on the slide, there are various publications that provide global analysis. I actually leave the research and publications as the last step because, as we all know, this can be a black hole if you don't have set parameters around what information you're looking for, or a trusted advisor that can help you sift through it. So as far as the publications themselves, let's move on to the next slide, and then we'll go more in depth in them. A good data point for real-time monitoring of country risk is the tracking of sovereign credit default swaps. As a country's risk is dynamic and constantly changing, this real-time method is useful to see the market's perception of risk between sovereigns and event risk due to domestic or global events. So in the chart here, albeit this is a dated example, but nonetheless, you see how the global market perceives Brazil to be riskier than Mexico, both of which are higher than the U.S. Credit default swaps are also a good indicator of event risk, as I mentioned. This shows fluctuations based on events that increase or decrease risk within a particular country or region. These can be domestic events such as elections, or here, in my example, you'll see that uptick in Brazil, and that was due to an investigation of the Brazil's president at the time in mid-May 2017. It also reflects increased risk of global events. So in the current environment, credit default swaps, if you go out and look at the current environment, they've you'll see that they have increased across the board. Other great publications, going back to the list in the last slide, are the IMF Article 5 reports, which provide in-depth analysis of countries, and that information is public and available free of charge. There's no subscription needed to gather that. Credit rating agency reports are also a useful resource. Moody's, S&P, and Fitch provide country analysis and outlooks, as well as analysis and outlooks for specific industries and companies within different areas globally. Lastly, I wanted to mention that I don't want you to underestimate the value of an in-country visit. I know these might have high upfront costs, not only financially, but also a high time commitment, or at times could also be logistically difficult. But these in-country visits can be used to build rapport with the client as you are showing interest in their market, their culture. They can be used to grow your customer base, as in-country clients can source opportunities and make introductions. And these visits are great as part of your due diligence process, which allows you to physically see their offices, physically see their manufacturing process, or even gauge their market share. How common is the name of your supplier or your client? It also allows you to connect with other companies that may do business with them. And let me give you an example. As a bank, we had a prospect that had a dominant market share in their country, their country of origin. So when we made our own in-country visits, we did learn that none of the local banks did business with them. So this was an initial red flag for us and had us digging a little bit deeper. In the end, we learned that these local banks had large debts that they had to write off several years ago from the company. We wouldn't have gathered that level of intel without the in-country visit. So those are some step-by-step process of thinking through engaging internationally. And now let me turn it back to Andy to talk through some tools that can be used to minimize risks that you come across as you do your due diligence.
Thanks, Susana. So wrapping up here on slide 9. So we shared our view of the world. We talked about different forms of risks and shared some views on how to assess those risks. So it's only natural at this point to review some tools to manage the risk. We're offering 3 primary tools on this page. There are more, but these are the most common. These tools can be utilized by themselves or combined with each other in more complex situations. And let's take a little bit of time to talk through each. So the first tool is a confirmed letter of credit. For those of you unfamiliar with it, it's primarily utilized to reduce the credit risk of foreign customers. With a letter of credit, for all intent and purposes, a foreign bank guarantees your foreign customer's payment, provided you perform on your commercial contract with your customer. It's a very effective tool to reduce credit risk, generally utilized, though, on repayment terms less than 1 year. There's a public registry that's published by the International Chamber of Commerce that covers default rates on letters of credit. And over the last 10 years, the average default rate observed has been about 0.1%. And that roughly maps to a double-A rated security over the same tenor. Now, there are disadvantages to a letter of credit. I think there are 2 worth bringing up. First, they tend to be more expensive than some alternatives. In fact, due to cost, you tend to see them utilized more heavily to cover transactions in emerging markets now. You don't see them as often as you used to in advanced economies. Second, they don't protect you from currency controls, so government interference. So think about it. If currency controls are levied in country X, and all you did was swap the risk from a company in country S to a bank in country X, you didn't mitigate it. You just moved it to another area that's still susceptible. So companies deal with this often by seeking to have confirmation of letters of credit that they receive. Now, with the confirmation that a company is seeking to find a bank outside of the country of the transaction, and that's generally going to be an advanced market bank with confirmations to offer a guarantee of the payment that the bank is supposed to make under its letter of credit obligation. Just giving you an example, you might have a customer you work with in Brazil that settles on letter of credit terms. You may have concerns with the country or the bank itself and decide to call us for risk mitigation, for example. In this case, if we'd like the risk, we'd offer to confirm or guarantee the payment in exchange for a fee. You would ultimately get our risk if you did this, because at maturity, our obligation to pay you is independent on whether or not we were paid by the issuing bank of that letter of credit. Okay, so the second tool, comprehensive credit insurance. Credit insurance is a contract between you and an insurance company to cover specific perils or losses. It's a very versatile tool. It can be used like a letter of credit to cover risk in the short term. However, it can also be used to cover long-term risks, such as expropriation of assets that you have in a foreign country that could be taken over by the local government under certain circumstances. Now, when you hear comprehensive policy in the short run, what you're buying is coverage for both the customer repayment obligation, but also any type of government interference, such as a currency control. However, you can also buy this on an a la carte basis. For example, if you are comfortable with the credit profile of the customer, you can buy coverage that only protects against the government interference aspect. In contrast, if you are comfortable with the country, but not the customer's credit profile, you can purchase coverage that only indemnifies you against customer failure to pay. Now, in terms of usage, for short-term credit risk protection, we tend to see it utilized more in advanced markets and less in emerging markets, though some companies do indeed use it in emerging markets as well. For longer-term expropriation risks, this tends to be more emerging market-centric. Now, there are disadvantages, of course, much like with a letter of credit, and I'll share just a few here. So I think the two main disadvantages are risk share requirements and conditionality. Unlike a letter of credit, where you are covered 100%, insurers will require you to keep 10% of the risk for your account. They want you to have skin in the game, and that's understandable, I guess. The other issue is a much higher degree of conditionality than what we see with a letter of credit. There will be several exclusions to coverage. There will be reps and warranties and obligations of the insured party that you will have to perform for the policy to be any good if you ever need to file a claim. It requires asset management throughout the life of the policy. Simply buy it and file it away if you want it to be good when the need arises. And far and away, the most important thing you can do is retain a broker with experience in credit insurance. So in many cases, the broker is the same as the one that a company may utilize to meet its general insurance purposes. Now, I will tell you, I'm a buyer of credit insurance for the bank, and the policies are definitely negotiated. So you really want to have somebody in your corner that's an expert to help you. And now I'll hit the last tool very quickly, asset sales. This can get complex, and for the sake of time, I'm going to keep this very simple. I'm not going to take it real deep. In a nutshell, many of the assets that are generated through cross-border, and in fact, even domestic dealings, can be sold to investors. This could be receivables or even deferred payment obligations that could be part of letters of credit. There are markets for those assets. Now, as an example, you might have a customer in Mexico looking for 180-day credit terms. Via an asset sale strategy, you could give them the 180-day term, but then you protect yourself by selling that asset. When you sell it, a couple things happen. You get your liquidity sooner, and you shed the risk of the asset as it's normally sold on a non-recourse basis. It can be a compelling tool in many markets, but particularly in emerging markets. The biggest disadvantage here is that it can be complex, and it requires an investor base to be able to do it. Now, generally, if you're going to go in this direction, you're going to need either an experienced bank or a finance company to help you perform on this type of strategy. And I'm going to pull up there for this afternoon. It's been a pleasure sharing our thoughts with you on an environment that seems to be changing rapidly by the day. Hopefully you found the presentation helpful, and we're happy to take any questions you have at this time. Molly?
Thank you, Andy and Susana. So I see we did have a couple questions actually in the chat. I will start out with Jean-Luc. Jean-Luc, it looks like you had a question about the impact of the election in the USA, so obviously the presidential election. Jean-Luc, if you want to unmute yourself and specify on your question, you can. Otherwise, I'll leave it to Andy.
Okay, I'll start answering, and if Jean-Luc, if you have any thoughts or questions that come to mind during the response, by all means, feel free, as Molly said, to unmute. I'll certainly say that's not a warm-up question. I mean, that's a tough one, and I think if you look at historic precedents of U.S. elections, what you will see is the uncertainty surrounding the election almost always has led to more tepid business investment, right? Which then has translated into weaker economic conditions, albeit temporary until there's more certainty with either the continuation or change of administration. I think the U.S. election this year, clearly coming on the heels of the COVID crisis, kind of gives the U.S., and I think the U.S. is really the only major country with an election across the globe the remainder of the year. It really kind of gives us a double whammy right now. So the uncertainty of when are we coming out of COVID, then, hey, who's our president going to be come the third week of January? So I think you're going to have that weighing down on U.S. growth prospects in the second half of the year. I think after we get beyond that, and I'm going to stop short of giving you my projection and feel on who I feel would be better for president of the U.S., but I think if I look at the two candidates, I think each, I'm trying to find the right words to explain this. I think each definitely has their own set of unique challenges. And I think as we figure out who the president is going to be, I don't suspect that the outcome will be significantly negative after the election occurs. I think you're going to continue to see either more of the same, or I think you'll see a replacement administration that tends to be center left. And I don't think this is going to be a battle where you have a very progressive stance versus a very, we'll call it conservative slash, what's the best way to describe it, against the grain type of philosophy. So I don't think even if there is a change, you're going to see a rapid change in philosophy that might spur, we'll call it a different bout of uncertainty that pushes into 2021. But having said that, that's not an easy question. Can I answer your question, hopefully, Jean-Luc? Okay.
Hi, this is Andre from the FACC-Chicago. There are a couple more questions that popped up, so just wanted to move on to the next one, if that's okay. What is Huntington's country outlook on France?
Yeah, so I appreciate the question, Frank. So, I mean, I think I'll answer it a little more broadly on Europe, and then I will kind of narrow it down to France. I mean, I think on Europe in general, we tend to view the path of Europe, at least over the next year or so, to be somewhat similar with respect to what we see in the United States. So we do believe that we will see a reasonable rebound in 2021 in Europe. With respect to France itself, there's a lot of different schools of thought out there. I mean, obviously, France has been immune to, we'll call it, political unrest that we're even seeing in major markets right now. So that does go down a little bit. specific to France. But having said that, we also do the French response to COVID to be pretty effective as well, in particular as it relates to them providing employment support but keeping people employed. So we view that as something that will likely allow them to mobilize and rebound quicker than markets that haven't done that. I think in a more broad sense, and I don't think this is an immediate type of concerns. I don't think you have a major election coming up here in the next 12 months. So I think when we get to that point, I'll be very interested in seeing how that plays out, because there's certainly some division in political concerns there as well, like you're seeing in many developed and emerging markets right now.
And Andy, I wanted to add that. Okay, can you guys hear me now?
Yeah.
That the ECB has been very aggressive as far as their accommodative stance. And the U.S. Fed, the ECB, and several other large economies are kind of coordinating efforts to mitigate the impact of this shock that we're in. And we've also done a deep dive in our group as far as the strength of financial systems globally. And if you compare France's stance today in 2019 versus where they were in 2007, the last time we had a large global shock, they are much stronger today. The financial system is much stronger today than it was, over 10 years ago. So that gives the financial system some leeway, as well as the quick response by the central banks globally will certainly help get the globe through this.
Thank you. Do we have it looks like we have another question. Could you share briefly Ex-Im Bank's capabilities during this time?
Yeah, sure. So for those of you that are unfamiliar with Ex-Im Bank, it's the Export-Import Bank of the United States. It's an agency of the U.S. government whose aim is to help companies with exporting their products into global markets. So if we look at the Ex-Im Bank, they provide assistance to companies in two ways. The first way that they do it is they are an issuer of credit insurance policies. What Ex-Im does is a little bit different than what you see in the private market with insurers. Ex-Im tends to be the insurer of last resort. So they cover the most challenging risks. And I can tell you, in dealing with them now, similar to what we're seeing with other U.S. agencies, such as the Small Business Administration, they're being very aggressive when it comes to supporting clients. Now, the second thing that the bank does is they help provide liquidity solutions by offering guarantees to financial institutions like Huntington when it comes to lending against foreign assets, whether those be non-U.S. receivables, inventory, sitting in different countries. So they offer, as an inducement to banks, guarantees, so we'll lend against those assets, which are oftentimes difficult for banks to do. Now, in terms of their posture, like I said, similar to other government agencies, they're being very, very aggressive. So some of the things that we're seeing them engage in is, one, purchase order financing. Right. So if you have a purchase order saying that you have a sales coming, they will treat that as something that you can lend against as collateral. And the other thing that they're working on, which I think is really unique, and for the bankers on the line, it's not something that you would generally think of in a lending arrangement, but they're also developing the concept of potentially exportable inventory. Right. So if you have inventory that, based on past trends, you feel that you'll be able to export as we emerge from COVID. they'll actually give you preferential advance rates up to 75% of the value on those assets. So they provide a tool to help banks with difficult collateral, and it enables, quite frankly, a lot of companies to expand export businesses or even just create liquidity in situations where they've never needed to leverage foreign assets in the past, but given, we'll call it budding liquidity issues now with COVID, it gives another source of access to liquidity that you might already have but haven't been tapping due to lack of need. And I'll pull up there.
Are there any other questions? Are there any other comments that you have, Andy and Susana, before we wrap up?
Outside of thanking the participants today, I'm good.
Thank you both very much. We will send a follow-up email to everybody who's joined us today with your presentation, if you will allow it. I think you and Molly probably already discussed that, but thank you both very much for your time and your insight, and to everybody who joined the call this afternoon. Have a good day, and be well, all of you.
You too. Bye-bye.
Thanks.
Thanks.
Bye. Thanks.